Welcome to the deep dive. Today, we're getting into something that, on the surface, might seem a bit dry, the dividend tax.
Right. Sounds like something just for accountants.
Exactly. But we're going to show you that this is so much more than a line on a tax form. It's really a battleground for big ideas, economic theory, political philosophy, even global competition.
It really is. The way a country decides to tax dividends says a lot about what it values.
And our source material for this is a really extensive overview of global dividend tax policies. So our goal here for you is to have you walk away with a solid grasp of, what this tax is, why it kicks off this huge double taxation debate.
A very fierce debate.
Oh, absolutely. And also how differently countries all over the world handle it, which in turn creates these wildly different incentives for companies and for investors.
So let's just dive in. First principles. What exactly is a dividend tax?
The simplest terms.
In simple terms, it's a tax that a government levies on dividends. And those dividends are just the slice of a company's profits that it decides to hand out to its shareholders. It's basically a tax on the income you get from owning a piece of a company.
Okay, and who actually pays it? Because it's not always as simple as the shareholder just writing a check.
No, not at all. That's a great point. The primary legal liability, so the actual obligation, that rests with the shareholder who gets the money. But, and this is a big but, in a lot of systems, the corporation paying the dividend has to apply a withholding tax. So they hold back a certain percentage, say 15 or 30%, and pay that straight to the government.
Before the investor even sees it.
Before the investor sees a dime. Now, for someone investing in their own country, that withheld amount is usually just a credit towards their final tax bill.
Right.
But for an international shareholder, that withholding tax might be the only tax they pay in that country. It's a huge deal for tax treaties.
And this, right here, brings us to the core issue, the central tension we're going to be talking about all day. This tax is applied on top of the corporate income tax.
Exactly. The company makes a profit, it pays tax on that profit, then it distributes some of what's left, and that distribution gets taxed again.
That's the double taxation everyone's always arguing about. The same dollar of profit is getting hit twice.
That's the phrase that defines the entire landscape. It's taxed at the entity level, the corporation, and then again at the investor level, the shareholder.
So naturally, because the second tax exists, companies and their owners have found some, let's say, creative ways to get money out without actually calling it a dividend. What are the main strategies they use?
The biggest one, and you see this everywhere, is the share buyback or a share repurchase. This is the go-to move in any country where the tax on capital gains is lower than the tax on dividends.
Okay, so walk me through that. Why is a buyback different from a dividend from a tax perspective?
It's all about classification. When a company pays you a cash dividend, that's usually taxed as, ordinary income or at whatever the specific dividend tax rate is. But when the company buys back its own shares, the shareholder is effectively selling an asset.
Ah, so it becomes a sale.
It becomes a sale. And that generates a capital gain, which in most places is taxed at a much lower preferential rate.
So if your capital gains rate is, say, 15%, but your dividend rate is 35%.
It's a no-brainer. The shareholder has a massive tax incentive to pressure the company to do buybacks instead of dividends. It's a very efficient way to turn highly taxed income into lower taxed income.
And it also has the side effect of potentially boosting the stock price for the remaining shares. A kind of win-win for the shareholders, even if it's not always the most productive use of that cash.
Absolutely. The second big strategy is, well, even simpler. Just don't pay anything out.
Retained earnings.
Retained earnings. The corporation just holds on to its surplus cash. That increases the company's book value and, in theory, the market value of the shares over time.
And you only pay tax on that growth way down the line when you finally decide to sell the stock.
Exactly. The tax is deferred, and when you do pay it, it's at that lower capital gains rate, so you get deferral and a lower rate. It's a very powerful tool for building wealth, even if it means capital gets sort of locked up inside the company.
Right. Now, with private companies, it seems like it would be really easy for the owner to just borrow money from their own company forever instead of taking a dividend. How do governments stop that?
That's a huge loophole, and that's where deemed dividend rules come in. This is critical anti-avoidance law in a lot of countries.
Deemed dividend.
Yeah. For a private company, the owner could just use company money to buy a car, pay for a vacation, or take a giant low-interest loan. They're getting the benefit of the profits.
Without the tax bill of a dividend.
Precisely. So to shut that down, tax authorities have rules that deem those kinds of transactions, like a loan that's not at a commercial rate, or a salary that's way too high for the work being done. They treat it as if it were a formal dividend for tax purposes. If they didn't, the dividend tax would be basically optional for any small business owner.
That sets the stage perfectly. You have the tax, but you also have these powerful incentives to work around it.
Okay, let's go back in time for Section 1 and trace how this whole thing started. The U.S. history is a great place to start because it's just been so volatile.
It's been a real roller coaster. But if you look at the origins of income tax systems in general, you see this philosophical fight over dividends right from the beginning. In the very early days, there was a strong argument to just exempt them completely.
And the logic there was simply to avoid double taxation.
Yes, that was the core principle. The economic thinking was, look, the corporation already paid tax. Hitting the shareholder again is just unfair, discourages investment. And that idea of fairness was actually pretty powerful in shaping early tax law. But I imagine the government's need for money eventually won out.
It always does, doesn't it? The first real documented dividend taxes pop up in the 17th century. We see them in places like the Netherlands and England.
The big commercial powers of the time.
Exactly. They had sophisticated markets, and they realized that profits going to capital owners were a clear, taxable source of wealth.
Yeah.
Then, as you move into the 19th century and more countries adopt modern income taxes, the dividend tax becomes pretty standard. It's a reliable source of revenue.
Okay, so let's zoom in on the U.S. The story really kicks off in 1913.
Right, with the 16th Amendment, which gave Congress the power to levy an income tax. The Revenue Act of 1913 that followed, it created a really gentle tax system. The personal income tax was just 1%, with a few surtaxes on top for the wealthy. And the corporate tax was also 1%.
So how did they handle dividends in that very first system? It wasn't full-on double taxation, was it?
No, it was actually a really interesting compromise. They were clearly trying to avoid that double hit. So dividends were completely exempt from that main 1% personal income tax. But, and this is the key, they were not exempt from the surtaxes, which only kicked in for incomes over $20,000. A huge amount of money back then.
So it was a way to tax the dividend income of the very wealthy without hitting small investors with that double whammy.
Exactly. It was a kind of an early, maybe clumsy attempt at integrating the two tax systems.
But that nuance didn't last long. The Great Depression changed everything.
It really did. The government was desperate for revenue to fund New Deal programs. So between 1936 and 1939, Congress just reversed course completely. Dividends were made fully taxable at the individual's ordinary income tax rate.
So the double taxation argument just went out the window.
It took a backseat to the national emergency. That period is really what established the principle of full classical double taxation in the U.S. system.
So what happened after the war? Did they stick with that high tax model?
No, the pendulum started to swing back. The 1950s brought a new focus on, encouraging investment and capital formation. The Tax Reform Act of 1954 was a big step. It created a separate lower rate for dividends.
An acknowledgement that the full rate was maybe too punitive.
Right. And that was built upon in 1981 with another act that brought in more exemptions and credits, all designed to lessen the tax burden on dividend income.
So we swing from full taxation to preferential treatment. But then it swings back again in the 80s.
A huge swing back. For an 18-year period, from 1985 all the way to 2003, dividends were once again taxed at the same rate as ordinary income. The big push at the time, especially the Reagan-era reforms, was for simplification.
A flatter, simpler tax code.
Exactly.
Right.
Treat all income the same. But that meant if you were in the top bracket, your dividends could be taxed at rates well over 40%, sometimes climbing towards 50%. That was really the high watermark for double taxation in the modern U.S.
Which brings us to probably the single biggest shift in a century, the Bush tax cuts in 2003. What was the thinking behind that dramatic cut?
It was a mix of things. There was a desire for economic stimulus after the dot-com bust and the recession, and a very strong philosophical argument against double taxation. President Bush made it a centerpiece of his platform, arguing it was just unfair and bad for the economy, especially for seniors living on investment income.
And the result was the JGTRRA.
The Jobs and Growth Tax Relief Reconciliation Act of 2003, a mouthful. But it completely changed the landscape by creating this new category called a qualified dividend.
And suddenly that term was everywhere. What was the magic of being qualified?
The magic was that your dividend was no longer taxed at your ordinary income rate. Instead, it was taxed at the much, much lower long-term capital gains rate. All of a sudden, income that might have been taxed at 35 or almost 40%, was now taxed at a maximum of 15% for most people.
That is a massive change.
A monumental victory for opponents of double taxation.
But those rates were temporary. They were set to expire, which created this huge fiscal cliff situation about a decade later under the Obama administration.
A huge moment of drama. If they had done nothing, the rates would have snapped back to the old system, top rates back near 40%. To avoid that shock, which people were calling Taxmageddon, Congress passed the American Taxpayer Relief Act of 2012, or ATRA.
And ATRA was a compromise, right? It kept the low rates for most people, but added a new higher tier.
That's exactly. It made the Bush-era rates permanent for lower and middle-income taxpayers. But for the highest earners, we're talking people with incomes over $400,000 or $450,000, it raised their qualified dividend rate from 15% up to 20%.
So let's just nail down how it works now. Since 2003, it's not one flat rate for everyone.
No, it's very progressive. It's tied to your ordinary income tax bracket. So people in the lowest brackets, the 10% and 15% brackets, they initially paid a 5% tax on their dividends. But here's a wild detail. From 2008 to 2012, that rate was cut to 0.
0%. A federal tax rate of 0 on dividend income.
0. It's a huge incentive for people just starting out, or for retirees. And that 0% rate has mostly stayed in place for those lower brackets.
Yeah.
Then you have the big middle chunk of taxpayers. They've consistently paid 15%. And only the very top earners, the ones in the highest income bracket, pay that 20% rate.
But wait, there's another layer, something that came in with the Affordable Care Act, the NIIT.
Yes, you can't forget the net investment income tax. It's a crucial part of the modern system. It came into effect in 2013, and it's a separate 3.8% tax that applies to, well, net investment income.
So that includes dividend.
It includes dividends, capital gains, rent, all that passive income.
And who pays this extra 3.8%?
It's specifically targeted at high earners. It kicks in for married couples with a modified adjusted gross income over $250,000, and for single people over $200,000. And it's in addition to the regular dividend tax. It's not a replacement.
And the really critical thing about that threshold, the $250,000, it's stuck.
That's the part people miss. It is not indexed for inflation. So every single year, as wages and prices rise, more and more people are going to cross that line and get hit with this extra tax. It's what's known as bracket creep.
So a tax that was meant for the very wealthy will, over time, start to affect more of the upper middle class. That means that the top effective federal rate on qualified dividends today is 23.8%.
The 20% plus the 3.8, and that number is just going to apply to more and more people as time goes on. It's just a perfect summary of the whole story. A century of swinging back and forth, ending with this incredibly complex, tiered system with this extra unindexed levy on top. It shows there's just no consensus.
That lack of consensus is the perfect entry point for Section 2, the core conflict. Let's unpack the arguments. Why do some people see this tax as completely necessary and fair? Let's start with the pro-tax side, the separate entity perspective.
Okay, so the whole foundation for this argument is the legal basis of a corporation. The idea that a corporation is, legally speaking, a person. It's a separate entity from its owners, with its own rights and its own responsibilities.
And the single biggest benefit it gets from being a separate person is limited liability.
Absolutely. That is the holy grail.
Mm.
It means if the company fails, if it goes bankrupt, your personal assets are safe. The creditors can't come after your house. You only lose what you invested.
And the argument is that this huge privilege isn't just a given, it's granted by society.
Exactly. It's not a natural right.
Yeah.
So there has to be a price for it. And our source material quotes Professor Ahmadi on this, and he's a very clear argument.
I remember that.
He says the corporate income tax is the price you pay for limited liability. And on top of that, this separate legal person, the corporation, it uses public goods. It uses roads. It relies on courts to enforce contracts. It benefits from a national defense. So it has its own independent duty to pay taxes to support all that.
And the scale of this is just enormous. The sources point out that while corporations are less than 20% of firms in the U.S., they generate something like 90% of the revenue.
The economic power that comes from that legal status is immense. So the logic follows. If the corporation is person A and the shareholder is person B, then when money moves from A to B, that's a new taxable event, just like your salary is a taxable event.
So from that perspective, it's not double taxation at all. It's just taxation. Two separate entities, two separate taxes.
That's the legal argument. There's also an equity argument. Why should someone who earns money from sitting on a pile of stocks be taxed less than someone who earns it through their labor every day?
A very powerful political argument. Okay, now let's flip it completely. Let's look at the argument against the dividend tax. This is the one you hear from groups like the Cato Institute. Why do they say it's so damaging?
Their argument is that the legal fiction is just that, a fiction. The economic reality is that only people can pay taxes. A corporation can't. And according to economists at places like the Treasury and the CBO, the burden of the corporate tax falls almost entirely on the owners of capital,
On the shareholders.
on the shareholders. So when you tax the corporation and then tax the dividend, you are, in economic reality, taxing the same person twice on the same stream of income.
And they say this creates huge distortions in the economy. Let's start with the one about debt.
This is probably the biggest one. Interest that a company pays on its debt is tax deductible, but dividends it pays on its equity are not.
The tax code subsidizes borrowing.
It creates a massive artificial bias towards debt financing over equity financing. This encourages companies to load up on debt, to become highly leveraged, and that makes the whole economy more fragile. When a recession hits, it's those highly indebted companies that go bankrupt first, and that can turn a small downturn into a major crisis.
But couldn't you argue that having debt forces managers to be more disciplined?
That's a counter-argument you hear, sure. The debt holders provide a layer of oversight. But the response is that the tax code should be neutral. It shouldn't be picking winners and losers between debt and equity. The market should decide the right capital structure, not the tax code.
Okay, what about the second distortion? The one about what executives do with all that cash?
This is the wasteful retention argument. Because paying a dividend triggers that second tax, there's a big disincentive to do it. So what happens? The cash piles up inside the company.
Creating a huge war chest for the CEO.
Exactly. And that creates what economists call an agency problem. The managers might be tempted to use that cash on projects that boost their own egos, like flashy mergers, instead of projects that are actually profitable for the shareholders.
So capital gets trapped inside a company earning a 5% return when the shareholders could have taken it as a dividend and invested it somewhere else for a 10% return.
That's the misallocation argument in a nutshell. It starves the most productive parts of the economy and bloats the less efficient ones.
This gets even more complicated when you try to figure out what a shareholder's actual income is. This is where hidden gains come in.
This gets a little technical, but it's so important. Your true income as a shareholder isn't just the dividend check you get, it's the total change in the value of your shares. That includes things like a company getting a new patent or cornering a new market. Those things increase the stock's value, but they're not taxed at the corporate level right away.
So when the dividend finally gets paid, what are you actually being taxed on?
That's the tricky part. When a company pays a $1 dividend, you get $1 in cash, but the value of your stock drops by about $1. Your net worth hasn't changed at that moment. The dividend tax is actually a tax on the past growth and past earnings that are now being formally recognized.
I see.
And that past growth is a mix of things. Some of it was from those untaxed hidden gains, but some of it was from profits that were already hit by the corporate tax. So it's a messy, delayed tax that absolutely includes a double hit on some of that money.
And it's that mismatch that drives all this tax planning and strange economic behavior.
Which is why our sources say that a broadly accepted solution to all these distortions, well, it's yet to be found.
The difficulty of finding any certainty here is perfectly summed up by that story about the French study.
Oh yeah, the 2022 study in the American Economic Review, it was a huge deal for a moment. It looked at what happened when France jacked up its dividend tax rates.
And it found the opposite of what you'd expect.
It found that, yes, companies paid fewer dividends, but they ended up reinvesting more of that money back into their own businesses.
Yeah.
The initial conclusion was, hey, maybe this tax doesn't cause misallocation at all. Maybe it even reduces it.
But then the story takes a turn.
A big turn. The study was retracted. Other researchers found, quote, inconsistencies in the data. It was a huge controversy.
Wow. To have a study in a top journal retracted on a topic this big?
It's a massive cautionary tale. It just shows how hard it is to get clean data and prove cause and effect in this area. Even though the original authors argued the issues didn't change the main results, the retraction itself proves that policymakers are often working with very shaky evidence.
So, given all this controversy, what are the big ideas for fixing this mess?
They usually fall into two buckets. You can either just lower the rates on dividends, on capital gains, on corporate profits to reduce the friction, or you can go for a more structural change to actually integrate the systems.
Like what?
Well, you could let companies deduct their dividend payments as an expense, just like they do with interest. Or a cleaner way might be to just make any dividend paid out of already taxed corporate profits completely tax-free to the shareholder. The goal is the same. Make sure that stream of profit only gets taxed once.
Right. And that really gets us into how different countries have tried to solve this. So let's move to Section 3 and look at the global picture because the variety is incredible.
The global data is fascinating, especially when you compare a country's tax rate on capital gains to its rate on dividends. That difference, that spread, tells you everything about its policy priorities.
Because, as we said, that spread drives the choice between buybacks and dividends.
Exactly. So let's look at the countries with a big positive spread, where the dividend tax is way higher than the capital gains tax. This is a giant flashing sign that says, don't pay dividends.
And who's at the top of that list?
South Korea is the most extreme. They have a massive 44 percentage point spread, a huge incentive for buybacks. Belgium is next at 30%, then Slovenia. These countries are effectively forcing companies to retain cash or use buybacks.
Then you have the neutral countries, the ones that try not to pick a side.
Right, the countries with a zero spread. And this list includes the U.S., which makes sense given the changes in 2003.
Who else is in that club?
Denmark, France, Germany, Japan, Spain, a lot of the big OECD economies. For the U.S., it means the top rate on qualified dividends is the same as the top rate on long-term capital gains. The policy is officially neutral on how a company should return cash to shareholders.
And then there are the weird ones, the countries with a negative spread, where it's actually more tax efficient to receive a dividend than a capital gain.
This is much rarer, but you see it. Estonia and Latvia have a big negative spread of 20%. Greece is at negative 10%. It's an unusual choice, maybe designed to encourage companies to pay out cash quickly.
Beyond just rates, some countries have entirely different systems. Let's talk about the imputation system in Australia. How does that work?
The imputation system is, I think, a really elegant solution to the double tax problem. It directly connects the corporate tax to the shareholders' tax.
So let's use an example. A company earns $100. The corporate tax rate is 30%. The company pays $30 in tax.
All right, so it has $70 left to distribute as a dividend. Under an imputation system, when it pays you that $70 dividend, it also gives you a certificate, a franking credit, for the $30 in tax it already paid.
Okay.
So you, the shareholder, declare the full $100 of pre-tax profit as your income. Then you calculate your personal tax on that $100. Let's say your personal tax rate is 47%. That means you owe $47 in tax.
But you have the $30 credit.
Exactly. So you apply that credit and you only have to pay the remaining $70. The beauty is the total tax paid on that $100 of profit, the $30 by the company and the $17 by you, adds up to $47, which is exactly your personal marginal rate. The corporate tax just becomes a prepayment.
That's a really clean way to solve it. It ensures the total tax burden matches the individual's ability to pay.
It's a very effective integration system.
Canada does something similar but different with its dividend tax credit.
Canada also aims for integration, but uses a gross-up mechanism. A Canadian shareholder gets a dividend, they have to gross it up by a certain percentage, and then they get a credit to offset the tax. It's notoriously complicated because of all the provincial rules, but the goal is the same. Give the investor credit for the tax the company already paid.
And they made a change in 2006 to distinguish between eligible and ineligible dividends. What was that about?
That was a way to fine-tune the system. Eligible dividends come from profits that were taxed at the high general corporate rate. Ineligible dividends come from profits taxed at the lower small business rate. The tax credit is bigger for eligible dividends to make sure the total tax paid corporate plus personal is roughly the same in both cases.
Okay, let's go Asia. India is just a wild case study in policy whiplash.
It's an absolute roller coaster. Before 1997, it was a classic system. The investor paid the tax. Then, in 97, they switched to a dividend distribution tax, the DDT.
So the company paid the tax instead.
Right, which made the dividend tax-free for the investor. But that only lasted 5 years. In 2002, they scrapped it and went back to the old system.
And how did the market react to that?
It hated it. The sources say it caused negative sentiments and stock prices fell. So what did the government do?
They switched back?
They switched back. In 2003, the DDT was back in, but they kept tweaking the rate upwards for the next 17 years. Then, in 2020,
They scrapped it again?
They scrapped it again. They went back to taxing the investor. The main reason this time was to attract foreign investment. Global investors find it much easier to claim tax credits back home when they're the ones paying the tax in India. It just shows how policy gets pulled between domestic needs and global competition.
It really does. Okay, let's round out the world tour with a few examples from Europe and, of course, the places with no tax at all.
In Germany, they have a flat withholding tax, the Abgeltungssteuer, of 25%. Then they add a 5.5% solidarity tax on top of that, so the total comes out to about 26.4%. It's a simple flat rate on passive income.
The UK, on the other hand, is very progressive.
Very. The rate is tied to your income band. It starts at 8.75% for basic rate taxpayers and goes all the way up to 39.35% for the highest earners. And they've also been slashing the tax-free allowance for dividends, so it bites almost everyone now.
And finally, the outliers. The countries that decided the easiest solution is just to have no dividend tax at all.
You've got some major economies on that list. Brazil is a big one. Hong Kong, a huge financial center, has no dividend tax. Iran, Singapore.
For a place like Singapore, that has to be a deliberate strategy.
Oh, it's 100% a strategic decision to be competitive. By having no dividend tax, you make your country an incredibly attractive place to set up a corporate headquarters or manage capital. It's a policy that prioritizes attracting global capital flows over collecting that specific stream of domestic revenue.
The range is just staggering. From zero in Singapore to complex integration in Australia to what is effectively aggressive double taxation in South Korea, it proves this is a strategic lever that governments pull.
It absolutely is. The policy choice a country makes really reveals its core economic goals.
So let's try to wrap this all up. We started with what seemed like a simple tax, but it opens up this huge unresolved conflict. The dividend tax is both a legal necessity to make corporations pay their dues and an economic distortion that punishes investment.
And that tension is still there. All these different global policies are just different attempts to manage that friction. There's no one right answer.
And the American story shows that policy is just constantly in flux, leading to the incredibly complex system we have today.
And we saw with the French study that even the data we use to make these huge decisions can be unstable. We're often navigating by theory as much as by hard evidence.
Which leaves us with a final thought for you, our listener. We've laid out the two camps. The people who say the tax is destructive and should be eliminated, and the people who say it's a necessary price for the privilege of limited liability.
And we've seen that the global trend seems to be moving towards either neutrality or integration to try and reduce those economic distortions.
So, with that in mind, here's the question for you. If you were in charge, how would you solve this? Would you prioritize economic efficiency and lower the tax on capital, even if it looks like a giveaway to the wealthy? Or would you maintain a strong second tax to ensure that the huge benefit of limited liability always has a price tag attached? Which solution do you think best balances the legal fiction and the economic reality of a corporation today?
It's probably the biggest unanswered question in corporate finance.
And that's all the time we have for this deep dive. Thanks for joining us. We'll see you on the next one.